Hey everyone, it's Justin Spittler, aka J Spit Trades. I want to welcome you back to the channel. Once again, we have a special guest. Today's guest is Larry Thompson, aka Hostile Charts. You can find him on Twitter. If you don't follow him yet, I do not know what you're doing with your life. But Larry reached out to me recently and he said he wants to talk charts. And I said, I'm game. And so we put together a little scouting report. We're going to talk breadth. We're going to talk advanced decline lines. It's going to be some good stuff. So Larry, you just want to say a few words about yourself and then we'll jump into these charts. Just tell people who aren't familiar with you just a few things about yourself. The CMT, maybe mention that.
Yep. So just took my level 3 CMT. Hopefully I'll get those results soon. As a career, I currently work as a CPA, so do a lot of fundamental work, but technicals is my true love. So we'll kind of dive in that today and kind of show you why we're wearing these, Trader Joe's looking.
This was a coincidence.
Yeah,
but,
Trader Joe's.
It's a bull market, so we're rocking the florals.
Facts.
But okay, yeah. You want to just jump right into it? Let's get to the good stuff.
Let's get it. Let's get after it.
All right, so we got the Nasdaq advanced decline line. What do you got to say about this one?
Yeah, so what I have to say about this one is a lot of people online get paid to put out things that make you scared. And so what I just kind of want to show you guys is that if it's news to you, welcome. So the Nasdaq composite has 2,500 stocks in it, and a lot of crappy stocks sit in that index. So what you'll see is the advanced decline line over time tends to go down because there's stocks within here that don't even have financials, right? They're going to get delisted soon. And so you see over time that the advanced decline line tends to go down, but the Nasdaq composite is market cap weighted. So the ones that win continue to win and build momentum in the fund. So that's what's happening here. And so my note here is just in terms of looking at the worst composite index in terms of the breadth of it, right? The bottom half of this index is pretty crappy. Just don't get scared by that. Follow price. Price has some information in it. And with that, if we're going to look at the Nasdaq, let's look at it more holistically and maybe look at new highs, new lows to see, is it continuing to break down or is it starting to break out? Because what you really want is you want to understand the market environment that you're trading in. That way you know whether or not to be long or short. Because what people focus on is a lot of times they focus on individual names a lot. But you'll notice everyone's a lot smarter and a lot luckier in bull markets than they are in bear markets. So let's determine the environment we're in, where we want to place our luck and get lucky. Because I don't know about you, Justin, but I don't mind luck.
I don't like fighting the trends either.
Exactly.
So yeah, you want to jump to the next one? I think we got some new highs, new lows. You want to discuss what you're seeing here?
Yeah. So like I said, the Nasdaq has been the, whipping boy for bad breath, bad breath, bad breath, bad breath. You've heard it, right?
Only 7 stocks.
Oh. Right. Only 7 stocks. But when you look at the Nasdaq new high, new lows, it doesn't take a genius to say it looks different, right? Look at the new highs. We just had more new highs than we've had in over a year in the Nasdaq, which, like we've talked about, very crappy stocks at the bottom half. Look at the new lows. It's becoming non-existent. And this middle panel is just the net new highs versus new lows. So looking at this, right, we're starting to have a lot more new highs than new lows. And that is something that would tell me I want to be looking at buying stocks versus shorting stocks, right? That just makes sense and it's intuitive, but that's why you start with the big picture, the scouting report before you run your plays. So from this, we're bullish, right? We're looking for setups that are bullish in the NASDAQ composite.
Want me to hit the next one? So
yeah, you can go to the next slide.
I titled this one Homies and Semis. So we got our home builders, we got some semiconductors on here overlaid with the S&P 500. So what are you seeing here? What's jumping off the screen?
Yeah, so we just looked at NASDAQ, looking at, a crappy index and seeing that our crappy index is actually making more new highs than it's made in over a year. That's bullish. Now we'll look at some just market internals, looking at different intermarket analysis, looking at home construction, semiconductors, and the S&P 500. 1, you can see they're all pretty correlated. 2, you can see they're all pretty close to all-time highs. And it doesn't take a genius to understand that if home construction companies are trading near all-time highs, right, and semiconductor companies are trading near all-time highs, and the S&P 500 is within 10% of all-time highs, that this whole recession narrative that was being pushed, the consumer is broke, the economy is struggling, it's just not a narrative that price was fulfilling, right? And price is what Justin and I trade on. And you could see here that price was telling us that the consumer was strong, right? People were talking about housing is the economy. Housing is the economy. Then if housing's at all-time highs, what's going on with the economy? And I read an article this weekend, didn't read it, just to clarify, saw an article this weekend, the Wall Street Journal, where economists are backing off on their recession doom and gloom.
Oh, here we go.
It's almost like price is smart, right? It's almost like price gives us information that we need to make decisions, and ultimately it's what pays us.
Yeah, two excellent bellwethers here. You already really spoke on the home builders, home construction, how important that is. But these semiconductors are the brains of the modern economy. They go into everything. So if they're doing well, for me, it's really hard to be too bearish on the economy or anything like that. So yeah, that's an excellent chart. It really, there's just a lot of information we pulled out from that single chart. So I love that one. But I want to follow up that chart with what I'm seeing in the nation's largest home builder. So this is DR Horton, DHI. And the reason I wanted to share this chart is that in the previous chart, we saw that those ETFs, which are invest in a basket of different stocks in those industries and themes, those are approaching all-time highs. But when you look at the nation's largest home builder, it had already broken out and it's sticking the landing. So it broke out, it held that level, and it just, essentially traded sideways, consolidated for a little bit, but that 10-week moving average, which is something I use on a lot of my longer-term charts, that's caught up to it, and buyers actually stepped in at that rising 10-week moving average. So this is really encouraging for me. It tells me that I don't think we need to be particularly concerned about false breakouts in those ETFs that you showed, because some of the leading stocks within those groups are already breaking out and holding those breakouts. So it's really encouraging. And it's the same thing in semiconductors. So we're all familiar of what NVIDIA has done. If you look at Broadcom, very similar. It broke out to all-time highs and consolidated and really didn't give a heck of a lot back after breaking out to all-time highs. So you have those two examples of breakouts that, essentially stuck. You know what I mean? They're working. They weren't false breakouts. But I've looked at a wide variety of semiconductor stocks, and I'm seeing a lot of them that had that breakout and just are starting to complete that breakout retest. So this is KLAC Corporation, the ticker's KLAC, and it had that breakout and had the retest, and then has since, it's been a few weeks consolidating, but that rising 10-week moving average is playing catch up now, and this looks great on the weekly. It also is starting to look pretty good on the daily. There's a lot of examples like this. Onto Innovation is another semiconductor stock that I've been sharing charts on Twitter, and it's pretty similar story. It's sticking the landing on that breakout. So that's just a couple things I wanted to add about what I'm seeing in the market right now. But we'll send it back to you. And in this chart, you're going to tell us what you're seeing in the stocks versus bonds ratio. So this is SPX versus TLT. What do we got going on here?
So great points made by Justin, right? In terms of, you look at the ETFs, you look at the broad market, and then you run your plays, right? And that's kind of the theme, is look at the market environment and then look for the plays within it. So that was a great job. Looking at stocks versus bonds here, right? This can be a proxy for risk on, risk off. It could be a proxy for fear, to gauge fear in the market. It's also kind of a proxy for interest rates to some degree. And when stocks are outperforming bonds, that's typically more risk on. It's typically an environment where you're seeing people are more willing to buy stocks than they are bonds, right? It's not more complicated than that. And this just continues to trade near all-time highs. So once again, the narratives that are out there just aren't showing up in price, and price is what pays us. So that's all I wanted to highlight here. Didn't want to spend too much time on it, but we just have more confirmation from some intermarket analysis that, hey, look at stocks. Stocks are doing well, right? We just showed you that one of the worst composite indexes that has a lot of crap in it is making new highs. It's probably not a bear market. It's a bullish environment.
Definitely. Yeah, that's another great chart. We got some more advanced decline lines here. So this one, you're comparing it to a few different indexes. So what do we got here?
Yeah, so I like to look at the AD line on a market cap basis, right? So we have S&P 500, large caps, mid caps, small caps, right? And so one of the themes here for this year so far was the fact that the S&P 500 was leading the way because of mega cap. Well, in bull markets, what we see is we see the laggards catch up to the leaders. In bear markets, we see the leaders catch down to the laggards, which we saw at the end of the end of last year, where, you know, kind of saw Apple, Microsoft start to roll over, but then they were the first to come back. And we saw that the AD line for the S&P 500 was the first to make all-time highs this past week, actually. And then that mid caps made all-time highs this week. So large made all-time highs first on a breadth basis from the AD line. Then mid caps made all-time highs. So now we're looking at small caps, and small caps are starting to turn around and starting to gain ground. This is bullish behavior, right? So this is a bullish, once again, bullish. And what you'll also see is if you just look at the charts that Justin shares, there's more charts to share. Why? Because more stocks are going up, right? There's more and more bases. I mean, Justin and I sit around this weekend just digging through charts because there's so many that look great, right? So if you don't have time to do the work, find people who do. And this is just one way you can see there's a lot of stocks out there that look good.
Yeah, definitely. And in the previous video I shared a chart of IWM, and IWM and small caps in general have really been a laggard, but they're starting to wake up. They had just broken that downtrend line that they had been in since late 2021. So it's encouraging to see them start to participate, because we already know how well the mega caps and large caps are doing. So for the other areas of the market to start to participate is, it's a healthy sign. So love to see it. What do we got here? We got a high beta versus low volatility. I'm guessing you're going to tell me this is bullish.
No, it's a bubble. Yeah. So looking at high beta versus low vol, right? There's been a beta chase, and it's not a coincidence that we had this fake out and then breakout. That's what tends to happen. Technicals, right? There are areas of interest. When you look at horizontal levels, there's perfection is the enemy of profit. That's kind of how I look at it. You have to kind of draw fat lines. And you can see here that once we made that higher low, we just went off to the races this year in terms of the beta chase. So the beta chase is on. So what do we want to be buying? High beta stocks. We want to be buying stocks that are outperforming, because in bull markets, people are sad either way. Bear market, they're sad because they're losing money. Bull market, they're sad because they're not making as much money as other people. So that's why Justin and I are going to work on another video where we show you some of those high beta names that are just now breaking out that could really help you juice your portfolio responsibly, of course, in the right direction if this move continues, which to me, I'm not seeing signs of slowdown in terms of the weekly, monthly charts, right? That's what I tend to look at. If you're looking at daily, sure, maybe, but I tend to zoom out a little bit. I like to hold on to trends for longer periods of time.
So Larry, I got to stop you before we go to the next slide, though. Just in common, barstool language, how would you, what are high beta stocks? Or your growth stocks? Well, what kind of stocks are high beta? What kind of stocks are low volatility? Maybe throw out some sectors or industries that would fit well with those.
Good question. So the more risky, right? The riskier the business. So semiconductors tend to have pretty high beta. You can look at some of the IPO names tend to have high beta. Companies that aren't established and don't necessarily have solid earnings yet, a lot of times that's going to be the case. They're going to be the high beta names.
Some ARK stuff.
The names that ARK stuff, exactly. Yeah. Stuff that's within the ARK fund, Cathie Wood types names that are to some degree still pretty speculative bets. Airbnb, Uber, those types of companies. Companies that are going to be low volatility are mature companies, companies that produce cash flows, have cash flows, energy companies, material companies, some consumer, some healthcare companies, right? Insurance companies. You're going to see companies that, right, they make money. They're what people have to buy over time. So
been around forever.
Exactly.
Yeah.
So that's kind of how you can look at it. Another ratio we can show you another time is just looking at consumer discretionary versus consumer staple. This is similar to that, right?
Yeah.
People buying what they want to buy versus people buying what they need to buy. A lot of the low beta, low volatility names are going to be stuff people need to buy. A lot of the high beta names are going to be stuff that people want to buy, similar to consumer discretionary versus staples.
Exactly. Makes sense. Okay. So next slide, sector performance. It looks like tech's doing well. These are some of these sectors at the top look like risk-on sectors to me, but what do I know?
Exactly, right? So this has probably been my favorite chart to share throughout the year. And if you go on my Twitter, you can kind of look and see that I've broken this down almost every quarter in terms of the performance and then comparing it to the sector rotation analysis. So what we have here is I did it equal weight so I could get rid of some of the naysayers or some of the trolls that are talking about market cap weighted and how that's ruining the world. Well, these are all equal weight sectors, right?
Yeah.
So technology, equal weight, consumer discretionary, equal weight, consumer services, equal weight are the top 4 performing sectors this year, right? That's pretty bullish in and of itself. What's at the bottom? Utilities, energy, financials. Financials, right? We know what happened earlier this year, but you also have consumer staples and healthcare that are kind of towards the bottom of the list. So this is just screams risk on to me. It screams high beta to me, right? It screams the names of companies that people are speculating to some degree on versus these solid cash flow companies. And if you go to the next slide, Justin, we'll just take a quick peek, right? So we just talked about technology being one of the top performers this year, the top performer, discretionary, communication services, and industrials. Well, if you look at this chart, that lines up with a market bottom pretty well, right? It actually lines up perfectly, but I don't like to use the term perfect, but it lines up really well with market bottom in full recession. So max pessimism happened late last year, right? When put call ratio was at the highest level it's ever been at. Sentiment was terrible. Everyone and their mom was telling us there was going to be a recession, and technology, discretionary, communication services were the best performing. That to me tells me to follow price out of that max pessimism and see what's leading. And that's what was leading, right? What we may start to see.
I was just going to say, turn off your TV and look at some charts, because that'll tell you the real story. But go ahead. Sorry to interrupt you. And you're speaking my language.
Yeah. And if you like looking at the TV screen, turn us on, right? Turn us on. The more you watch us, the more content we can create and the more we can bring you and add value to what you're trying to do, which is, I hope, make money and provide for your family. So this is just an interesting chart because it worked. It worked perfectly, and people just ignore it. And it's kind of funny if you look at these next couple slides. Justin and I didn't talk about this in advance, but we kind of wanted to see where the puck might be moving. And I won't spoil it, but it's kind of funny that materials, energy, consumer staples, and healthcare might be where money starts to move a little bit, right? Doesn't mean the others are going to underperform or that they're going to break down. It could just mean they trade sideways and digest some of their recent gains. But it's kind of funny because Justin ended up pulling up these charts and sees potential for them to get bought.
Yeah, so I on Twitter and in prior videos, I've shared the charts of XLK, which is the tech sector ETF. I've also shared XLY, which is the industrials ETF, and those are both broken out to new all-time highs. But I was curious, and I wanted to discuss in this video other sectors for where, as Larry said, the puck might go next. And so the area that I think could tag or test its former all-time highs next would be materials, but there's also 2 other sectors that I'm bullish on for this rotation theme that Larry discussed. So we look at materials. When I look at this chart, I had been charting the industrials chart, XLI, and this chart really reminds me of that chart. So it bottomed in late September, early October, and from there had that impulse move up. So it actually kind of led the market off those lows, but it hasn't really done much in the past few months. It's just been building this base, but I think it's starting to wake up. We can see that it's back above the 10-week and 30-week moving average, and it's starting to bump up against the highs of that range that base has been forming. So this is an area of the market where I definitely think we could see some rotation into in the near term, and it's the sector that I think will test or go to new all-time highs next. So that would be materials. That's one area we're paying very close attention to. Consumer staples are also really interesting to me. Again, a chart I've shared before if you follow me on Twitter. So we had this bottoming pattern. We actually had this breakout attempt. We broke the downtrend line, but we couldn't stick the landing. So we pulled back. Essentially, a first breakout attempt was a failure, and it looks like we just needed a little bit more time. And look here, we're starting to, the past few weeks, we've really been trading sideways, and it's starting to look constructive to me. And I think it's only a matter of time before we break that downtrend line that has been in place since about spring of 2022. We break that, I think consumer staples can begin a new uptrend because the past few months, really, they've sort of been consolidated and haven't made a heck of a lot of progress, unlike some other areas in the market. And the next area of the market, which also jives with the rotation theme that Larry discussed, would be healthcare. And so this is a chart that a lot of people have shared recently, and the discussion around this chart was this consolidation pattern and XLV a accumulation pattern or a distribution pattern. Distribution pattern is just trader speak for basically a topping pattern. But I think this will ultimately resolve higher because that's just the trend that the overall market has heading in, and it would also jive with what Larry was discussing in terms of sector rotation, as this could be an area of the market where the puck goes next. So definitely watching this chart very closely. You can see we've started to get a little tighter recently, and to me that suggests that big moves coming. And based off of everything I'm seeing right now, I think the next move for healthcare stocks would be to the upside. So if we get these three sectors involved, it's going to do wonders for breadth. It's the narrative that it's only 7 stocks, it's only 5 stocks, it's only tech stocks. I think we can completely dismiss those narratives at this point. If you're doing your homework and looking at the charts, then there's no reason to believe those narratives. They don't hold up to inspection, essentially. So I think that's it for today. I think we covered a lot of ground. This was a great first edition of the scouting report video, but anything else you want to add? I think that's our last slide. Sorry I didn't put you on this.
You're good.
This last one, I'll have to get you on next time. I just forgot.
Good. Yeah. The only thing I would add here is just what you might see, and what we want you guys to know is this was just an overview of kind of how we're seeing the market from a broader picture, right? Later on in some videos, we'll give you some individual trades and some individual plays, but this is just kind of the broad picture of, okay, where do you want to be doing? Do you want to be buying stocks or selling stocks? The last thing I would just add is we need bears to sell our downtrends to and buy our uptrends from. So I really am a fan of bears. And so I will also just say, you might start to see headlines in the news of tech is starting to break down, consumer discretionary is starting to break down, the consumer's dead. But we just showed you that what happens in bull markets is you see that rotation. So when that rotation happens, that is not something that you panic sell. It's something that you look for those dip buying opportunities in those consumer discretionary names. And then you also rotate some money into those other areas of the market, right? Because you want to be bullish if this is the bullish environment, which from the charts, it looks like it is. So that's just something to keep in mind, that the bears will always be bearish. They will find ways to be bearish, but just understand the broader picture and the weight of the evidence that can keep you in bull markets. Because the goal of a bull market is to get you out of it.
Exactly. Couldn't have said it better myself. I think that's it for today's video, though. Thanks for everyone for tuning in. If you enjoyed the video, be sure to like it, be sure to follow, and comment if there's something you'd like us to discuss in one of our upcoming videos. But I appreciate everyone for tuning in. So thanks for joining me, Larry. Of
course.
All right. Take care.